You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, our monthly update series for August 2013, and on today's show, the insurance industry update with special guest, millennial marketer himself, Eric Palmer.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain, and back again to talk about, wow, you go on vacation and you're missing a carrier. Eric, how you doing, Eric?
Glad to be here.
Eric, while you were gone, having a wonderful time.
Right.
Lincoln Benefit Life was sold. Allstate sold Lincoln Benefit Life to Resolution Holding Company out of UK. I have to tell you, we knew there were rumors out there. Remember,
right.
we'd heard about that.
Right.
I didn't think it was anywhere near as imminent as it turned out to be. And on top of it, the bigger shocker, they're not just buying Lincoln Benefit. There is not going to be any Lincoln Benefit sales going forward. In fact, by the time you're watching this broadcast,
it's done.
There it is. You're done. There's no way to submit any more business.
We were shocked. You hear rumors all the time.
Right.
Somebody's buying somebody, this is doing this, and a lot of it doesn't come to fruition. But I was shocked to come back and find out that it actually had happened. And you have to wonder, I guess Allstate may be moving into a capital position of some sort. They want to, create some additional reserves perhaps. But it was shocking to hear that they're shutting the doors because Lincoln Benefit Life has really created a good name for themselves in this industry. And they laid off somewhere around 1,000 people. It's more to come. It's quite shocking.
I know when you think about Little Lincoln, Nebraska, that's small enough.
Right.
So it's going to be hard. And, the only closest carrier over there is United of Omaha. You're going to have to drive 45 minutes to work.
Right.
And I'm sure they're going to have the pick of the litter. So
absolutely.
Yeah, let me say this just from my own standpoint. I've been, of course, in the business now for 30 years. I did my first Lincoln Benefit app in 1989.
Wow.
So we're talking, and think about this, I received the persistency bonuses on the annuities that we sold from 1996 back.
Wow.
So it's kind of a heartbreak. There are certain companies I don't shed a tear for when they left our distribution,
right.
And I'll stay unnamed since I don't want to get sued. But I'm really sad to say we knew so many people at Lincoln
right.
Benefit, and I'm going to say a big kudos here. Everybody talks about service. Very few carriers come through.
Right.
Lincoln Benefit was one of the few that were, 24/7. They did a great job in servicing. I don't think I'm the only person we're the only IMO talking like this.
Absolutely, and they had great software. We've used their software in some of the training, so it is sad to see them go, but our hats off to them for what they did in the past and the name that they built for themselves. And hopefully we get to see some of those folks somewhere else in our industry.
Well, as I always say, and this is tongue-in-cheek, so don't take it seriously, the only revenge for having a foreign reinsurer come in and buy Lincoln Benefit is replace. So I'm only kidding. We're
going to mute that part.
Okay. Well, let's talk about, we talked about this Monday show. This is affecting product now, the rise in interest rates, right? And you're going to start seeing some of these carriers kind of edge up not only annuities, which we talked about on Monday,
right.
but this is going to start to affect life insurance. Current company assumption, you're going to get indexing is going to be affected. Check it out, some of the guaranteed funds on VUL.
Right.
This is all affecting things.
It is, and it's interesting because it's not just being reflected, especially on the life insurance side, with increasing just an annual point-to-point cap. Mm-hmm. We're seeing things like what Allianz had come out with, where they've got these inverse strategies. There's also a lot of different sort of creative index strategies that are coming out with very strong interest rates, and so it's nice to see that uptick. It's very much related, I believe, to the 10-year Treasury and some of the other movements that we've seen in the markets. Let's just hope it lasts.
Now, when you say inverted, like when you brought about Allianz, were you talking about their 9% trigger?
Right, the trigger performance strategy.
Talk about it, because I don't think, even though it's been out since late May, right? Or no, late April.
Right.
I don't think maybe we need to do a show on this or so, because I don't think anybody really has heard about this. And every time I bring it up, people go, "What are you talking about?" Talk a little bit about that and introduce us to that.
Well, sure. Well, trigger performance strategies, we've actually seen them mostly on annuity products, index annuities, and they're really related to the ability to take and create the capability of getting a full cap if the index performs within the range of the cap. So if you get a 0.1% movement in an annual year time, say on the S&P 500, you actually get credited the full cap. And it's interesting that, and it has a lot to do with leverage, and it'd have to be a whole show because we'd have to
Right.
draw the model and how the option purchases work and how they're hedging against that.
Let me make sure I understand this right, though. Let's say a point positive. I don't need
you're
a
a
lot
penny
here.
over.
I get 9%.
9%.
And I don't care what it is. Now, of course, if it goes 12, I get 9%.
Right.
Okay, if I get nothing, I get 0, like we all have on all
Right.
our traditional products.
Negative numbers is 0.
I would say if you're looking, I'm wondering how this is going to affect, would that affect premium financing? My thought was this, hey, if you could lock down, you're already doing indexing over there anyways.
Right.
If you started looking at 9 at any uptick, why would that not affect that?
Well, it'd be a very positive move right now. But with premium financing, we also have to remember there's a collateral and some
Sure.
other movement pieces. But it's always important to outperform your
spread,
interest.
right.
That is the cost. And actually, I would say it even more applies to some of the income strategies that we see out there today. If I am taking and borrowing money out of my contract, out of my cash value, and I have a strategy that pretty much gives me a very good opportunity to have at least 350 basis points over the rate I may be borrowing my money at from the insurance company, that's a pretty good hedge. And when we know that the S&P's volatility is pointing towards slower growth over time because we know that we inevitably at some point are going to have this increasing interest rate environment, I'd be looking very closely at a trigger performance strategy.
So this could be a wave. And do you see other carriers kind of looking at this now?
Absolutely. North American's a company that also is very much involved in trigger performance
Big time.
strategies.
Right.
Their annuities are embedded with them. They have been for a very long time. So I would just continue to pay attention to the spreadsheets and things that we put out. Annuity specs is a great tool to use for something like that as well, so you can spreadsheet those trigger performance. But I wouldn't be ignoring it. I would not be focused solely on an annual point-to-point.
If you caught our show Monday, you saw, we talked about Genworth's roll-up annuity. They're thinking, remember now, we haven't heard anything about this, they're thinking about putting that same strategy on their IUL.
That would be great.
Oh my gosh. I love the innovation of we are the most creative people on the earth. I hate to say it, a little pat on the back there. When we come back from the break, our insurance industry update for August 2013 with Eric Palmer. And don't forget, you can enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's material at thebiz.tv. And while you're out there, click on the Biz blog for the Backroom Technician 30-day free trial offer to access their best needs analysis and educational material that address almost every planning scenario. And remember, as always, when we say anything about tax or anything else, before moving forward with anything on the show, always consult your tax advisor and your legal counsel as well as your broker-dealer compliance officer if you're FINRA licensed. We're in the middle of our monthly insurance update, and we were talking a little off-air during commercial about inverted rates. Now, it's so funny, we always talk about, we just talked about 9% trigger. We're talking about how innovative we are. We're talking about how creative. Now, let's talk about another area of creativity, which sounds so counterintuitive to me,
Right.
but it's so cool. Talk about this inverted way of looking at the index. Are we selling short now?
Well, we have inverse strategies that are available, and again, mostly on these annuity products now, but it'd be really great to see them come over to the life or the index universal life side of the coin. But these inverse strategies essentially allow you to take the positive gains on a set cap in a negative year. So if the S&P goes down, typically we end up with a 0. But if you have some of the money allocated into these inverse strategies, by going down, in effect, we actually could be maxing out the cap in that particular strategy for that year. So let's think about this for a second.
Yeah.
The S&P 500 12 months ago was in the 1,300 ranges, and now we're in the 1,600 ranges, right?
Exactly.
So we're somewhere sitting around a 23 to 25% gain from the last 12 months. So do we really think that the roller coaster has more room to go up, or do we think it's going to go down? And we all know what market volatility looks like. It's usually a couple of years here, a couple of years here, and it does this type of a wave. And you can look back to the history of it and see that it does that. So if you have the ability to predict or if you feel very confident that there's a good chance that the S&P could have a down year in the next 12 months, then I would do two things. First, I would make sure that your client understands you might get a 0 this year. It's probably the best thing that you're going to do for your practice, because your client can anticipate the 0 and understand how powerful that is to not have a negative number. You're going to have a good relationship with your client. But also, if you have the foresight to start using some of these inverse strategies, when you can see that the S&P is obviously on a very high trend, then you might want to suggest that you reallocate some of their money or a portion at least of their money into these inverse strategies, so that if that happens, you can call your client in a down year and say, hey, look, we made a little bit of money here.
Well, we had a couple carriers that were doing this, and then they pulled back on that. They didn't offer it on the life side.
Right,
the life side.
right.
But now we're moving down that. And I have to say, talking about index, Eric, again, not to give kudos to our industry. I'm not trying to do a self-serving pat on the back. We are the most brilliant people on the face of the earth. But I have to say, our industry, I just read this huge article about collective trust funds. And now they're saying in defined benefit plans, think about this, they're moving into index funds.
Right.
We've been doing this for years.
Right.
And they're saying like, wow, 2/3 of CTFs now are in index something.
What's really interesting about that is, we've talked about it on the show before, and sometimes you see the commercials. We have a program called IFL. It's Income for Life. It's an Index Universal Life sort of sales presentation software and calculators and the whole package of how to really grab a hold of that market. And some of the key things that we put inside that presentation are quotes from Warren Buffett, where specifically over the last several years, he's talked about the importance of introducing index funds into your overall portfolio because it has volatility controls built into it, right? So it's interesting that we hear that from Warren Buffett so many years ago, and then of course in our industry we've been preaching it since indexes have come out to the market. The power of 0, the capability to have an index read sort of a general movement in the economy or general movement in industry rather than specifics related to one particular entity or being actually related to straight equities where you take these large losses at any given moment. So it's funny, we've always been talking about on our side of the coin, it's nice to see that defined benefit plans are starting to grab a hold of that because they recognize that they need to get rid of that volatility in those plans.
I love it when we are a vanguard or a pioneer, or can I say a harbinger, because we always get so much flack, and it's a good time to see, oh, by the way, people are following the leader.
Well, I think our industry is really good at recognizing the effects of market volatility. We are math people. We're mathematicians, if you will, when it comes to financial planning. And the reason we focus so heavily on insurance products is because we have the ability to leverage against volatility, and we've seen what volatility will do to somebody's retirement plan. So again, it's exciting to see that other people are grabbing a hold of that, because at the end of the day, market volatility has a very dramatic effect on your ability to retire on time and have enough money.
Talk a little bit about, since we're all on indexing, let's talk a little bit more, because this has been making the news lately, and it's really to our kind of semi-shame with our whatever time we have left. IUL for income, but we're still doing it at Target when we shouldn't be.
Right. Well, there's a couple of things that come to mind for me. First might be a big lack of education. And we've preached it quite a bit here on the show that education is key, especially when you're selling products like index ULs and you're making predictions using interest rate assumptions and the capability of what today's current loan rate is inside of a contract. So remember, those are assumptions, those are not guarantees. And when you're just sticking to target premium, you're really limiting the capabilities of the product to perform, to provide enough cash value, to provide a decent stream of income for your client. The second thing that comes to mind is we've, and I'm not calling anybody out, but I think that at the end of the day, we got to pay attention, especially as BGAs and IMOs, to advisors out there that are solely selling target premiums. There's been a lot of issues out there with rebating. There's been a lot of issues out there with certain loophole strategies inside of products. And at the end of the day, whether or not it's benefiting the client in a short-term period of time, it's not benefiting the industry. So we have to remember that target premium funding doesn't necessarily make sense for all these clients. You got to pay attention to if it's happening, and again, if you have questions about that, I'd say get in touch with us and we can help you out.
Yeah, because if you're doing income, you should be suppressing that death benefit down to the Tamra regs. Everybody that knows this, we've been doing this since 1990, and really, we need to return to this whole platform. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me, steve@thebiz.tv. Well, that's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.